Yes, so where to begin? Perhaps I should start graciously and thank the CATO Institute for inviting me to be able to share my perspective. I'm particularly glad since my organization is cited as some of the data sources. So, and perhaps I can also begin by agreeing on the LTV issue. Gail and I used to argue about this, and Gail would say what you will about her. She was very dedicated to underserved people, and you know, approached it in a different flavor. But I always felt that, just like the banks, I think homeowners needed to have skin in the game. So I'm not in disagreement. Where we fall out on how much of that skin in the game needs to be is perhaps where we differ. But as Bob said, we can kind of figure that out as we go along. But let me get into the meat of what I want to say, because you know, Ed, I don't know if you know it, but you ended your presentation by saying "end of show," and it was a good show. I'm, for one, you know, I'm not one of these folks who's like totally impressed every time someone gets up and mentions a bunch of numbers and throws some charts up, because I've grown tired of watching dueling economists who, you know, take the same subject and then take their reports and compare it to this other report, and somehow they're in total diverse perspectives. And so at the end of the day, you know, someone once told me that, you know, they invented economists so that astrologists would look good, and perhaps there's, you know, perhaps that's unfair.
Lawyer, so.
Yeah, he's a lawyer. That's the defense to my comment. Okay.
I don't want to be merged, called an economist.
Okay, I got you. That's how bad it is. Lawyers who want to admit to being lawyers, not economists. I'm a lawyer too, so. But here's the thing. You know, like, I'll take the example of how he started. He said President Obama said that it wasn't CRA. And President Obama has gone on to explain that, and he cited some of the studies that Bob has cited. But the other folks who said it wasn't CRA are the very folks that he talks about whose banks supposedly suffered from this. So the head of Citi, the head of Wells, the head of Chase, the head of all the big banks, and almost anybody who's intimately involved in the front lines of how these loans happen from a perspective of managing large portfolios and making it happen, have said it wasn't CRA that caused this problem. But so if you don't want to believe President Obama or the Federal Reserve, and I think we want to reemphasize what Bob said, you know, that recent study, the most recent study, more recent than most of the data that Ed used, said from the Federal Reserve, hardly a bastion of liberal thought, that the percent of high-cost loans that could be attributed or done by CRA-regulated institutions was less than 6%. In fact, most of the banks that he cites up there, and to his credit, Ed cited Countrywide and some of the other things which have now been absorbed, but even some of the big banks in those days, Ed, who were doing these kind of loans that really were problematic, high cost, that really, I think, brought this country down, our economy down, were done by either the mortgage side of those financial institutions or by independent mortgage companies. Can you all say Ameriquest, New Century, Option One, Countrywide? All those institutions that have since failed and got out of business because of, you know, because of their bad business practices. But also in the banks, you may not know this, Ed, but it's a ridiculous rule that the regulators have. The banks get to pick and choose whether or not they want to count their operating subs. So Citibank gets to decide whether they want to count what Citi Financial does for CRA purposes. And they don't. All these major institutions didn't count all those subprime high costs because those loans would have been flagged by the CRA regulators as not being safe and sound. And I want to say that. Here's the CRA law. It's all of a page and a half. And, you know, 2/3 of it is definitions. But here's what it says. Financial institutions have an affirmative obligation to meet the credit needs of the communities from which they're chartered to serve safely and soundly, including, not only, but including low and moderate income neighborhoods. But safely and soundly is in the law. It's in the statute. It's not in the regulation. And so, aside from the fact that a very small percentage of these were originated by CRA regulators, aside from the fact that it has to be safely and soundly, you know, I had lunch recently with Alan Greenspan because he was in the Wall Street Journal, cited by probably the person in my book who created more of this problem than anybody, and is probably a patron saint of the CATO Institute, and that's Senator Phil Gramm. But Senator Phil Gramm wrote an article in which he cited Chairman Greenspan as saying CRA contributed. And when I had lunch with Chairman Greenspan, I'm like a pet community guy for him. He graciously, plus he confuses me with the John Taylor who is the conservative at Treasury under the Bush administration. So when I call his office and say, John Taylor wants to speak with you, it always comes back, which John Taylor? And I always say, the good John Taylor. But, and I've actually become the good John Taylor because the other John Taylor is actually quite critical of the chairman these days. So, but he graciously sits with me, and we've gone through this, and really looking at the minuscule. I mean, this whole presentation is CRA's contribution to this financial debacle, you know, if you allow me to paraphrase Ed. But the truth is, and you're not going to get me to sit here and admit that it had anything to do with it, because had the regulators been doing their job, even whatever minuscule loans were done under the guise of CRA, they should never have ever been done in an unsafe or unsound manner. I've always said to the financial institutions, you want to kill CRA? Make a bunch of bad loans. This wasn't, let's talk about what it really was about. And look, just because you support the free market, that doesn't mean you can't be critical of it. You know, even Adam Smith, the most important thing for a healthy democracy is a free market. But don't leave out the second part of his statement. Overseen by a rule of law that ensures fairness. And you know, I'm paraphrasing him now, but it ensures that it's done in an ethical way. That's what really happened here. We had Wall Street flush with a lot of money looking for investments because at the time, investments in mortgage-backed securities and CDOs in the United States was a good investment for people in Iceland and the French Dental Pension Association and everybody else. Double-digit returns was a great thing. And so you had all these young guys fresh out of, you know, Dartmouth and Harvard and Yale and business schools, and they're sitting there and they're earning $10 million a year just moving this money, and but they saturated the market in terms of where to invest. And so they turned around, and at the same time, and here's the convergence, the Basel Accords that Bruce mentioned, up until 2001, basically Fannie and Freddie had the advantage. If you had a Fannie and Freddie secured loan from Basel Accord, the capital reserves for you were the least amount that you needed to have if it was a Fannie or Freddie securitized loan. Well, guess what they did in 2001? They said, or unless it's AAA rated. The rating agencies. And who pays the rating agencies? These very same investors and banks who bring these portfolios to the agency, says, here, rate these. And by the way, rate it good. Otherwise, I go to Moody's or I go to S&P, you know, to your competitor. And here's the thing. If you don't think that happened, consider this. Those high-cost loans that were really the bad loans that Ed and others have referred to, that were created by these mostly non-bank institutions, 85% of those high-cost loans were AAA rated. These rating agencies, I'm trying to think of a nice word for it, but really stuck it to the American public and to the American economy by colluding with these investors. And the investors said to these brokers and to these lenders, make any loan, we will buy it. So no documentation, low documentation, it didn't matter. And all the broker, for those who don't know, all the broker had to be, or that loan office had to be concerned with, is that borrower paid their loan for 3 months. Sometimes it was 6 months. Between the 3 to 6 month period, your fee became permanent. So they knew. I mean, all you got to do is look at a lot of these loans, and you would know, well, this was an unsustainable loan. Why would they make this? Because they got their fee, and they weren't on the hook for it. They had no skin in the game. This went to Wall Street. Wall Street made its money, and those young guys who were moving made their fees, and the folks who really got it stuck to them were the investors and the American public as a whole, because this malfeasance practice. And watching this all happen were the regulatory agencies. And make no mistake about it, we spent a lot of time talking to people under the Clinton administration, talking to people under the Bush administration, that these loans were unsustainable, they were unfair, and they were going to create problems. I have letters going back to when Ellen Seidman was head of the OTS, and then all through the Bush administration saying this is problematic. And when did the Federal Reserve, which had the authority since 1994 from Congress to issue unfair and deceptive rules and practices to prohibit the kinds of things that we all know happen now. 1994, Congress gave them that authority. When did they finally move to actually end all these low doc, the things that Mark referred to? When did they finally move to actually do this? July of 2008. This is long after the market collapsed. This is after Wall Street itself stopped securitizing these things. This is after all these loans had stopped being made. Finally, the Federal Reserve moved. And so, you know, you can, it's sort of like, it's almost like a little thing. It's, well, you can continue to say it's CRA, but it just, the facts don't support it. What really drove this is the free market that we all love and adore, that's made this a great country. But if we can't be critical about the malfeasance and the inappropriate behavior and the greed that can really distort a great democracy and a great capitalist system, if we can't do that in a way that's critical enough to really correct those kinds of things, instead, you want to blame poor people for having brought down this nation? How silly is that? We need to make sure this market is fair, it's equitable, it's ethical, and it doesn't create the opportunities where lenders like Mark are saying, you know, gee, money's everywhere, I can do this, someone's going to buy it, because his thing is get his fee, get in and out. And I don't agree with whether it's 100% down. I said that, Ed. I don't agree in doing stuff in which really the risk is taken totally out of the hands of everybody involved. I think we need to have that. So let me conclude by saying that you know, you've been out of the banking business for a while. You're in the independent mortgage business, right?
In mortgage business until about a year and a half ago.
A mortgage business until a year and a half ago. Well, then you should know. You talked about the regulatory burden of CRA. The American Bankers talked a lot about this, American Banker newspaper. And they always list CRA as the least regulatory burden of all the regulatory burdens that are imposed on financial institutions. And I don't doubt, because I hear from enough, that there's a lot of paperwork for financial institutions. But the problem is not CRA, and particularly for small banks, because most of you may not know this, but a CRA exam for you, for a small bank, only occurs every 5 years. So in a 9.5-year period, you might have seen these examiners once. Big banks, it's more frequently, every 2 or 3 years. But they have departments and capabilities of responding to that. So, you know, let's not throw the baby out with the bathwater. The concept of home ownership being a very valuable thing. The Heritage Foundation, I love to be able to cite conservative organizations when I make my points, but the Heritage Foundation maintains that home ownership is the most stabilizing influence for any neighborhood. So it's a good thing to aspire to. Should there be people who would not get these loans? Absolutely. Because they're not ready? Absolutely. Or because the risk is so great it doesn't make sense? Absolutely. But the folks who need to decide that, the desire to become a homeowner is not something that all of a sudden grew overnight. It's always been an ideal for people in the American public. What we always had, though, up until very recently, less than 10 years ago, is we had a financial services system that would not make you a loan if they didn't think you could afford to pay it back. What a novel concept. You overlay an affirmative obligation to make sure you don't ignore low and moderate income people when it comes to mortgages with that concept of being responsible in your lending activities, and we have the kind of robust and competitive and envy of the world financial services system that we once had. But you take that stuff away, the regulatory oversight, the ability of people who are not regulated the way banks are, independent mortgage companies, credit unions, and you allow them to practice what they want, we end up with the kind of situation we're in. So blame CRA. The facts really don't support you. You can say it until you're blue in the face, and I suppose, you know, people will go on and say, well, I heard this great presentation. I can't repeat everything. There are a lot of numbers and charts. But the truth of the matter is it had very little to do with this economic fiasco that we're in, and continues to have very little. And that position is supported by the banks themselves, the major banks who are the biggest purchasers of loans and maker of mortgages in this country. So thank you very much.
Thank you, John. I appreciate the comments, and certainly very glad to hear that you're enthusiastic, as I think we all are, about actually everybody having some skin in the game, from the borrower to the lender to the investor.